Good afternoon, sir. Good afternoon, sir. Good afternoon. I'm Shruti Shukla. I am a student of PGDM Securities Markets here at NISM, and I'd like to extend a very warm welcome to all our paper presenters, all our esteemed guests, and our chair and discussant. This session will be chaired by Tirthankar Patnaik, Chief Economist, NSE, and our discussant for today is Jainendra Shandilya. Before we begin the session, I'd like to give a brief introduction of our panelists. Mr. Tirthankar Patnaik is Chief Economist at the National Stock Exchange of India. He has over 2 decades of experience in the Indian capital markets, academic research, credit research in macro and sector strategy, quantitative finance, and consumer banking. Dr. Patnaik started his career as a researcher at the Indira Gandhi Institute of Development Research and has worked on a number of academic and corporate projects in the area of econometrics and quantitative finance, followed by a stint in consumer banking analytics as an analyst with the global consumer group of Citibank in India and Europe. His next focus area was equity strategy for institutional clients, initially with Citigroup Global Markets as India equity strategist, and then with Railager Capital Markets Limited as the India strategist and chief economist. In his last assignment prior to joining NSE, he was the chief strategist and head of research for India at Japan-based Mizuho Bank. Welcome, sir. It's an honor to host you here.
Thank you, Shruti.
Our discussant, Mr. Jainendra Shandilya, is currently working as the Assistant General Manager in the Market Regulation Department of Securities and Exchange Board, India. He joined SEBI as a manager in 2001 and has worked in various departments within SEBI, including investigations, enforcement, inquiry and adjudication, communications, and the Office of the Central Public Information Officer. Previously, he was a faculty member at the National Institute of Securities Markets, where he taught fixed income and derivatives. At NISM, he was also Program Director of Postgraduate Diploma in Quantitative Finance, Postgraduate Diploma in Data Science, and Postgraduate Diploma in Financial Engineering and Risk Management. He has over 20 years of experience in banking and securities markets, and he has published over various articles on securities markets, which have been carried out by various newspapers, magazines, and journals in India. He has been a guest speaker at many colleges in Mumbai and at various national and international seminars on matters related to finance and capital markets. It's such an honor to be hosting both of you and also all our wonderful attendees. Before we begin the session, I'd also like to walk you through the guidelines. A total of 15 minutes will be given for paper presentation, upon completion of which a bell will be rung. Post this, 2 minutes will be given for the presenter to conclude the paper. Now, this will be followed by 7 to 8 minutes of discussant remarks, and an additional 5-minute slot will be allotted for question and answer. I'd now like to request our Honorable Chair to kindly take the session forward.
Thank you.
Thank you so much.
Good afternoon, everybody, and it's an absolute pleasure and a delight to be here physically at the SEBI NISM conference. This is the 3rd SEBI NISM conference, and I had the good fortune to be in this exact same room 2 years back as when I was discussing a paper. That was an excellent paper then. And then who knew how things will change in our lives. And the pandemic came upon us, even though statistics says that tells you that the odds of a pandemic were not that low. People never really think. We then went back 100 years and recognized, oh, there was a Spanish flu then. And after 100 years, we have been welcomed by another virus. So last year was online. It was an absolute delight. The quality of papers in this conference keeps one pleasantly surprised. And this time as well, I have the pleasure to chair this particular session, where the idea is how the COVID-19 pandemic has affected our lives. There are 2 papers which basically talk about what has policy uncertainty done with the advent of the COVID-19 pandemic, and how have stocks behaved during that particular time. We have a 3rd paper which does not specifically talk about the pandemic, but it essentially looks at how certain securities move around earnings price announcements, and the affiliations of each of the papers is excellent, and I look forward to this particular session. May I now invite Mr. Shandilya to you're going to discuss the papers.
Yeah.
So I can now start with the physical presentation first. So the first paper that we have today is on the effect of COVID-19 and policy uncertainty on the stock market, evidence from India. It is by Masudul Adil from the Indian Institute of Technology, Palakkad. Sir, you have 15 minutes. Thank you.
Myself, Masudul Adil. I am working as a postdoc fellow in IIT Palakkad. So thank you so much for giving me the opportunity to present my work on the effect of COVID-19 and policy uncertainty on the stock market, evidence from India. So the outline of the presentation would be as such. Yeah. So introduction, then statement of the problem, then research methodology, empirical analysis, and then finally conclusion. So just briefly introducing the topic as such. So as we have seen that there are various macroeconomic fundamentals have been affected by the pandemic itself. So if we look at the impact of pandemic on macroeconomic fundamentals, then broadly 4 channels we can categorize. The first one can be considered as the external demand, then second is the domestic demand, then third one is the supply disturbances, and then financial market disturbances. So the first one, the external demand, because there was a strict lockdown in advanced and emerging economies as well. So of course, there has not been generated a lot of imports from our domestic economy. So it has been shrink a lot. And then looking at the domestic demand, then if we categorize the domestic demand in terms of private consumption and public consumption, then of course public consumption has been increased a little bit of it, but private consumption has not increased that much. And if you look at the investment side, then of course investment has also narrowed down because of the COVID effect and all. If you look at the supply disruptions, so because of the strict lockdown, as you know that India is one of the largest intermediate good importer. So because of the lockdown, we couldn't able to succeed in the importing of the intermediate goods. And inside the domestic territory as well, there was lockdown. So interstate movement of the transportation was not happening that much. So of course it might have affected as well. But here I'm concerning with the financial market disturbances. So what the motivation behind this work to do is that because financial market more or less moves with the scent of fear, right? So the motivation behind this work is to carry on that what kind of sentiment it has, the impact of sentiment it has on the stock prices, focusing on the economic policy uncertainty and this Twitter-based market uncertainty. So if you look at the literature, so conventional determinants of the stock market has been categorized in terms of domestic production, interest rate, inflation rate, exchange rate, and all. So these are the studies like Anari and Kulari 2001 paper have discussed, Daimaniowski and Saha 2015 paper. So they have mentioned different determinants of stock prices, but the component or explanatory factor of economic policy uncertainty, and more recently, which is developed by the economic policy uncertainty group by Baker and all, they maintain this uncertainty index, is the Twitter-based market uncertainty. So these literature have neglected these two explanatory factors, which we envisaged as that in terms of affecting the macroeconomic fundamentals by considering the uncertainties. These two indices are too important, and we should consider of it while looking at the stock prices determinants. So in terms of uncertainty, I have taken the COVID-19 index, which is again segregated into two different indices, but first one is the aggregate COVID index, and then second is the vaccine index. So why I have taken two different kind of indices? Because in postulation, aggregate COVID index might be having negative impact on stock prices because of the fear of pandemic, and vaccination index might be creating some positive sentiment towards investor. So it might be having some positive impact on the stock prices. So just to testify, we have postulated this hypothesis. And then finally, Twitter-based market uncertainty index means how many number of tweets about uncertainty and pandemic people are making, and then accordingly, how does it affecting the stock prices. So the research methodology to carry out this statement of the problem is as such. Firstly, we have gone through the basic integration properties of the variable under consideration, followed by augmented Dickey-Fleur and Phillips-Barron unit root test. And then based on the integration properties of the variables, I have considered the co-integration method, which is developed by Discussant et al. 2001 paper, that is known as auto-regressive distributed lag model. So one of the main advantage of this co-integration methodology is that if even though the variables are integrated of order different variables, different order integration, for instance, I0 and I1, or it may be a mixture of both, then in both cases, we can apply this ARDL methodology. So this was one of the main advantage apart from other advantages. Then finally, just to test the stability of the model, I have just gone through the Pizarro 1997 test, and then cumulative sum and cumulative sum squares of residuals developed by Brown et al. Paper 1975. I have just tested the model to know the parameter stability of the model. Then finally, to gauge the model adequacy, some traditional kind of diagnostic testing I have applied, which is considered as serial correlation, heteroscedasticity, normality, and functional form specification. So this is the ARDL functional form over here, where the stock prices as a function of COVID index, then vaccine index, then oil prices and exchange rate, and then finally Twitter-based market uncertainty index. So looking at the empirical results, which I have extracted from the time series analysis.
Could you go back one slide? Yeah.
Yeah.
What is ER?
Exchange rate.
ER. Yeah. Go ahead.
So looking at the unit root testing properties. So in case of our study, we got the mixture of integrated variables I1 and I0 both. So because of that, it provides us to more stronger evidence to go for the ARDL methodology of bound testing. So here we have applied the bound testing approach of co-integration, where we calculate the F statistics, and just to how to conclude this bound testing approach, because Pizarro has given two kind of critical values. One is the lower and another is the upper bound critical value. So if the F statistics is greater than the upper critical bound value, then we reject the null hypothesis of no co-integration. And if the F statistics is lower than the lower critical bound value, then we fail to reject the null hypothesis of no co-integration. But in case if F statistics is going to fall in between these two critical regions, then test result would be inconclusive. So here, in case of our study, the F statistics is here coming giving the more constructive and conclusive result. So based on the suggestions of Creamer and Creamer paper and Banerjee paper, so we have concluded our co-integration result through the ECN, error correction term. Is it working? No.
You can use the arrow key, right side arrow key.
Yeah.
It will work. Down.
Okay, anyhow, so this is the error correction term here, minus 0.08. This one, error correction term here. So which is significant, and it is reinforcing the long run results. So if you look at the short run coefficient, so more or less all the coefficients are showing the significant results or significant impact on the stock prices, except here in vaccine index, which is insignificant over here. But if you look at the long run coefficient result, so in the long run COVID index, which is aggregate form of the COVID index, here negatively affecting the stock prices, and vaccine index, what we have postulated in our hypothesis, it is showing the positive impact on stock prices. And some of the series of diagnostic testing I have carried it out, so it is satisfying well over here. So based on the empirical result, what we found, basically there exists co-integration among variables, which is concluded on the basis of error correction term. The second thing is that in the short run, all the explanatory variables are affecting the stock prices except the vaccine index. because it may be the insignificant result of vaccine index, maybe because it takes some time or some lag will be there to show the impact on the stock prices. Then finally, in the long run, COVID-19 index in aggregate form and vaccine index are having negative and positive respectively impact on stock prices. So in conclusion, what we get here, there exists co-integration among variables by considering the time series econometrics under consideration and the time period as well. And second thing is that stock prices, we can conclude that are responsive to both favorable and unfavorable impact of in Indian economy in terms of uncertainty, what we have recently faced up. Then finally, what would be the policy implication of this study is that what we suggest over here, that if policymakers want to protect investor sentiment and provide them a safe haven, then the policymakers should bother more about controlling the upheavals which is caused by the uncertainties in the Indian financial market. So here in conclusion, uncertainty is going to be happen one of the major determinants of the stock prices, which we must consider while framing the policy. So thank you so much.
So thank you. Are there any questions? Anybody?
The question is at the end.
After discussion.
On the discussion.
Yeah, you
Okay,
can
Mr.
do-
Shandilya,
Yeah,
please.
okay.
Please.
Okay, please, should I go there?
Yeah, please go. Yes.
Excuse me. This is the paper that you present, right? Okay, sir, thank you very much. So before I start, I would like to make a little disclaimer in the sense that okay, yeah. So all the papers that are being presented over here are very good, and that's why they are here. But my duty is to find out the flaws in that, so that if something you can take some cue you can take from here, or maybe as a reader, like I'm a practitioner in market, practitioner of regulation, practitioner of as an investor also I do this. So my discussion will be mostly confined to that committee. So what I realize in your paper is the models used are good, and that way the paper does a fairly good job of bringing out the whole situation of what happened due to COVID. Yeah, wait. Okay, fine. Let it go. So my only concern is the data that you have used is only for a very brief period, somewhere around 1 year. I think for anyone to conclude, say something with a strong conclusion, you require a little longer period, especially in the stock market, because your paper is mostly focusing on the uncertainties governing the prices of stocks and other things. So it should have been a little longer period. Or what you could have done, you could have taken the taper tantrum period, you could have taken the dot-com bubble, you could have taken the subprime crisis, and then this could have been a little more elaborating in that sense. Because 1 year to me doesn't make any sense. Why? Because I'm a very long-term investor, and most people would like to look at 5 to 10 years, even to the least 3 years for, to the minimum. So that's where this doesn't do justice with the reader, because any conclusion, if I can base on this short term, will not be very valuable. So that's one. The other thing is that the use of Twitter-based market uncertainty that you're using is nothing but this is a proxy for all the variables that you have talked about, whether it's a production, interest rate, exchange rate, inflation, or whatever. Because basically it's capturing all of this. Because that's fine, but because it's only being used for a short period of time, so the stability for that, I will have my doubts. So. And what you say is the stock market is responsive to both favorable and unfavorable shocks is like statically obvious. It's like, so this paper in a way is reinventing the wheel in its own way, in the sense that everyone knows that like if interest rates are reduced, market is going to react favorably. If there is a war, for example, today, Russia has attacked Ukraine and the market is spilling blood. So that's obvious. So I would be looking for something where probably you could have brought out some more nuances of the fine points related to all these uncertainties. And one more thing, that the good thing that you have talked about is, in the interest of investors and to provide them a safe haven, the policymakers need to be bothered more about uncertainties prevailing in the financial market. So I think taking a cue from your paper and all the policymakers do, this is what. So US Fed immediately the COVID struck and they reduced rate. So the financial paper in the Western media, they wrote that if there is an attack from alien, the first thing that the US Fed will do is reduce rates. So policymakers are always there to listen to all these kind of shocks, because that's what they've done. And I think similar thing was done over here by the Central Bank of India. So policymakers are anyway, I think our jobs and everybody's job is centered around that uncertainty, which is there. So I would have been more happier that if you could have brought out some finer points in between them as to this is something that was lacking and that was not addressed, then probably that would have looked more. Otherwise, models are good. Actually, models are more like the fascinating screenplay. So they will look good because like you have fed the data and they are doing the job. But the outcome of that model should have been more elaborate in the sense that the period, extended period, and their ramification, and probably you could have used this in some other countries. So that's all. I don't have any other question because otherwise what you are stating is obvious. So nothing much from my side. Otherwise, a good paper, everything. Thank you very much. Thank you.
Thank you. Am I allowed to make one or two statements? I think I'll absolutely add to what Mr. Shandilya had said. I had actually written one more thing. See, in your presentation, it would have been great if you had spent some more time on the question than on the methodology. I can picture myself 25 years back exactly doing the same thing. I was so enamored with the econometrics techniques. Maine ye kiya, maine wo kiya, maine ye kiya. That is coming out quite well. But it would be nice now, because I have the hindsight of so many years of pain, that what is the key question? What you are showing here is I can also do these things, which is very well and evident. Okay, and if one wants to really go nitpicking into the techniques, but that's in an econometric conference, we can do that. But here, if the audience would have been, in my humble opinion, happier if rather than showing, yes, I can do all these things, what exactly am I doing different? So as Mr. Shandilya pointed out, the classic case is, you said it's positive, the uncertainty index from Baker, that affects negatively, vaccine affects positively, and then you get vaccine also not really significant at some point. The vaccine proxy becomes insignificant. Interestingly, if you had taken a slightly longer period and said, say, pre-COVID, post-COVID, or pre-COVID, during COVID, how do things change? That is one choice. Other choice is exactly as he pointed out, take previous crisis, take the GFC, take the taper tantrum, take period between, say 2007 to 2009. When we had the GFC, there was a trough and then you got back. Taper tantrum 2013, mid 2013, until at least August, September 2013, things were pretty uncertain. That would have been also helpful. Problem is you will get the economic policy uncertainty index there because Baker and all were doing at that time. You will not get the Twitter index. So there is some data, the technique is probably doable only with 1 or 2 more years data, which is worth doing. But it's interesting to then focus on what am I doing different. And another thing is, I would agree. It's nice to have a non-trivial conclusion to the analysis. This is nice. I mean, nobody will disagree with this conclusion. But if you say something that does not immediately, occur to us, that would make the paper better. Thank you.
So is it possible that can I add something?
Please do.
To begin with, I must say, he has made good efforts.
Yes.
The only thing why the journey for him to be a researcher or be an analyst or even be an investor, various capacity who you would be, always try to address what is your motive and what is your purpose. That has to be fundamental. Motive, what made you and what is the purpose of your study. And also show how many literatures review. You can just say number or different kind of things. And both the sirs, they already say, what are you, example, all of us would have been more happier that if you given one or two things inside, watch normally we would not have been known because of your efforts, because you would have spent, could be 15 hours, could be 500 hours, whatever. That should, give us some insight. And probably then our feedback might have been much more different, and that would help all of us to be, looking at those things. And as they say, they are from the policy making body, they would be more happy, to take few of these things. So be on the line and please take the feedback. We always call, in excellence, we call it area of improvement. Because I'm there as an assistant with CII, we follow the EFQM, and with IMC also, we are following the Malcolm Barnett. So we always call for him is areas of improvement.
Okay.
But good efforts. Yeah. Keep on learning and make improvements what is required. Thank you.
Thank you. Thank you, Masudul. Could we, if you want to discuss later, of course, there.
Yeah.
Could we go on to the next paper now? So the next paper is COVID-19, Stock Liquidity and Abnormal Returns. It's going to be a webinar, and it's by Praveena Musunuru and Mohammad Shameem from IIM Visakhapatnam.
Good afternoon, sir. Am I audible?
Yes, you are. Yes.
Is my PPT visible?
It is. You have to go to presentation mode, please.
Yes. Good afternoon, everyone. I am Praveena Musunuru. I am a third-year PhD scholar at IIM Visakhapatnam. The title of the paper is COVID-19, Stock Liquidity and Abnormal Returns. It is co-authored with my supervisor, Dr. Mohammad Shameem Jayanth. So the main idea of the paper is to understand how the ex-ante liquidity of the stock, that is before the crisis, has a relationship with the abnormal returns that are experienced during the COVID-19 crisis in the Indian context. We have used three different measures of liquidity: price-based, volume-based, and transaction cost-based measure to understand the relationship. And what we find is that these three measures behave differently with their relationship, and price-based liquidity measure shows us that liquid stocks are more penalized during the crisis, whereas volume-based liquidity measure has the same relationship during crisis and calm periods. Zero has not given any significant trend or relationship that we can interpret. So the motivation of the study was that we know that liquidity is of prime importance to practitioners, policymakers, and regulators to keep our financial system stable. Especially in an emerging market like India, it becomes more important. And why this study is interesting, because in normal times, we all know that that liquidity and expected returns, their relationship is negative. That is, the more liquid a stock, expected returns will be less. And the more illiquid a stock, the expected returns will be more, because investors need a premium to hold illiquid stocks. But it will be interesting to see that during a period of uncertainty, when there is a lot of negative information and a lot of investor panic, there will be a sudden selling pressure which will be created in the market. And because of this, we can see that there might be a change in the relationship between ex-ante liquidity of the stock and abnormal returns. And especially in India, we saw that the stock market fell and rose in a span of 2 months, which is a very short period. So this will give us a good experimental setup to understand this relationship, because other firm variables have not changed much. Further, if we have seen past studies, they have studied on aggregate market liquidity, and there is no Indian study which has looked at specifically ex-ante stock liquidity and abnormal returns relationship during COVID-19. So coming to the literature review during crisis, these are some of the papers which have looked at aggregate liquidity of the market. One of the oldest papers is by Amehud et al., who examined 1987 market crash and found that the illiquidity of the market has increased as a whole during the crash, and it even remained 7 months after the crash. Zaremba et al. And Harun and Rizvi, they have seen this in the COVID-19 context, and Zaremba has seen it with respect to the policies and found that with the workplace closures or school closures, the liquidity of the market has overall decreased. And Harun and Rizvi has found that as the number of COVID-19 cases decreased, the liquidity of the market improved. Now coming to specific studies on stock liquidity, again, Mahmood et al. Has mentioned in his study that stocks with more liquidity problems may see greater price decline. Then coming to global financial crisis, Batten and Vo has seen that there is a positive relationship between liquidity and returns during GFC. If we look at Justin Economist, who has done a study during COVID-19, we see that there is no correlation between stock returns and stock liquidity. Whereas Wang et al., who has examined all the market crashes, finds that ex-ante Amahood's illiquidity is a significant determinant of stock returns. So from these studies, we see that there is no clear relationship that has been established, whether it is positive or negative. So it is interesting for us to understand in the Indian context, what would have been the relationship, because in the case of, even though COVID-19 was a sudden surprise to all parts of the world, India also had many surprises, like we had a sudden lockdown, which we were not aware of. So investors have panicked. So what is the contribution is we primarily contribute to the financial markets literature, which focuses on market reaction due to pandemic and stock liquidity. And this study is important to practitioners and investors because it makes them understand what are the nature of the stocks based on liquidity measures that they should consider in their portfolio to minimize the risk from some such market uncertainty. So we have taken 1807 active firms listed on NSE. The trading and financial data is captured from CMIE Prowess, and we broadly segregated these firms into 5 sectors using NIC and KLEMS classification. We took Nifty 500 stock returns from Thomson Reuters. So coming to methodology to calculate abnormal returns, our dependent variable, we have used event study methodology with market model. Then we have performed a multivariate regression to understand the relationship between liquidity and abnormal, ex-ante liquidity and abnormal returns. So the 3 measures which we have used for ex-ante liquidity are, for volume, we have used turnover, price impact, we have used Amahood's illiquidity, and for trading cost, transaction cost based measure, zeros. So to understand how the relationship changes during calm periods and crisis periods, we identified four key event dates. One is 31st December 19, when there was no confirmed case in the world of COVID-19 and only cases of pneumonia unknown etiology were reported to WHO. Then 11th March, when WHO declared it as a pandemic, is our onset middle of the crisis. 24th March is when India declared lockdown. These 2 are crisis periods. 31st May is again a calm period because India has started its unlock process, and we have also seen a recovery in the Nifty 50 index. So these are our variables. As I said, abnormal returns is dependent variable. We have taken 3 proxies for liquidity, and we have control for market variables as well as firm variables. These are summary statistics of variables of interest, and we can clearly see that the abnormal returns during the calm periods, either in a flat market or rising market, are positive, whereas during the periods of crisis, the abnormal returns are negative. Since we have used 3 liquidity measures in a single equation, we wanted to see whether there is any multicollinearity problem. So we looked for correlation, and we find that they are not correlated. Everything is less than 0.4. This is the main empirical framework which we have used. And these are the results which we have found. So if we look at turnover, it is negative in all periods and significant. If we look at Amahood's illiquidity, it is positive during periods of calm and recovery, like on December 31st and May 31st, it is positive as established in the literature. But what is interesting is we find that its relationship is negative during the periods of the crisis, and it is highly significant. Coming to zero, there is no trend that we see, and it is not significant. So these are the control variables. To understand more about this change in direction of the relationship and the feedback we received from NISM, we divided the sample by sorting them on Amihood's illiquidity from small to large. Then we took the top quartile as the highly liquid stocks and bottom quartile as the illiquid stocks. And what we find is more interesting, because if we see for highly illiquid stocks, the relationship between Amihood's illiquidity and abnormal returns is showing as negative, but it is not significant. But if you come to highly liquid stocks, we can see the same relationship which we observed before. It was positive in calm periods, and it has changed its direction to negative during crisis periods. Turnover has almost shown the same relationship we have seen previously. So from this, what we are able to interpret is that during the period of crisis, there was more trading activity, more volume, and it is the liquid stocks who saw the more fall in prices compared to illiquid stocks. So those investors who might have had a portfolio of highly liquid stocks might have suffered more during this crisis. So this is an insight which we are providing to the investors and practitioners. So we have also done a robustness test. We have taken alternate event window of 7 days and saw whether the relationship has changed, but it remains same. We have also controlled for industry, because in COVID, we know that different industries had different abnormal returns, but still we find the same relationship. So what we are trying to conclude is that during the period of uncertainty, as on 11th March, when WHO declared it as a pandemic or sudden countrywide lockdown, we have seen Amihood's illiquidity is changing its direction of relationship with abnormal returns. And this relationship is positive during calm and crisis period. So this shows that stocks which had higher ex-ante liquidity got more penalized. This is evident from both turnover and Amihood's illiquidity measure. And transaction cost bit measure did not show any trend. Thank you.
Thank you, Praveena. May I request the discussant to offer his comments? Praveena, is this visible to you?
Yes, sir.
Okay, great.
I think this is different, no?
Yeah, I'm going back.
Yeah. This is
That's for the next slide.
Sumit's paper.
It's all right.
Yeah. Okay. So Praveena, this something about the way you have written the paper. I have gone through your paper and thoroughly enjoyed reading the. Can I be heard?
Yes, sir.
Yeah. So I thoroughly enjoyed reading the paper for a number of reasons which I want to point out before I proceed on the contents of the paper. So one is for the first time I've never seen before that each sentences have been indexed in the paper, which is a great effort because, you know, if I have to give it to a student of mine or if I have to refer to it, then I can exactly tell you at the sentence, the line number 74, this is, so you have beautifully categorized everything in the paper, which is a great thing. The other thing is it flows beautifully from the beginning till end. Of course, there are some hiccups in between, but that's okay. But it flows beautifully from the beginning till end, and I can read it and like it as a story, which is a great thing.
Thank
The
you so
best
much.
part, yeah. The best part is you have touched upon liquidity, which is the blood of the market. So it's like a romantic love story being shown in Bollywood movies. So everyone is going to lap it up because it's something that is in the heart of everybody. Liquidity is all of us are chasing during market hours, off market hours also, and whenever you make a decision to get into or get out of market. So, and the best part is all the citations that you have used are one of the best citations available in this particular domain. So for example, if you talk about aminoids, liquidity and all that, you will see hundreds of literature around that. And then the best part in your paper also, you have mentioned it over 10 times and like that. So that shows the importance of this paper. And many other citations that you have used are good. So literature review comes up very well in this particular case. Why not? Yeah. This I have said. And yeah, so the regression model that you have used is very robust and that you support it by doing the alternate measures, which is good. So it looked good to me that you have substantiated with an alternative ways of doing it. One thing where I want to come back to you is when you use beta in your regression, and I have not seen in other papers also, so I will come back when I discuss other papers, you never mention where from you are taking your beta. So for example, I witnessed that most of the researchers have a tendency to just take beta from the database that they are using and copy it and do it. But over here in market, we never do like this because our purposes are different. So we take either 3 years or 5 years and we show it that this is the period that we use. And in some of the cases, we try to use our shrinkage estimators to make beta more stable. So I would request you, whenever you are mentioning using beta, one line of comment on where from you used and what is the duration of the period for which you have used the beta, because that makes our understanding of the parameters a little better.
Okay, sir.
Yeah, and so one of your findings is price-based measures are better than volume-based measures. So which is obvious, which is what you have shown. And like you say, investors should focus on ex-ante aminoids liquidity measure to take steps to reduce their losses, which is also like a fine. It is established, and this is what you are saying. Your robustness is further confirmed by 7 days window +3 and -3, which is what you showed, which is also like in line with your 11 days period, which you showed. Now, one thing where like I have slight differences, but of course, like you have taken a period different. You say highly liquid stocks based on volume suffer more during crisis. So you mean to say Nifty 50 will suffer more during crisis. So I want to show you something. This is today's market at 1:30 when I was leaving for the conference, and I thought this screenshot should help you. And what it shows is what you have found out, contrary to what you are saying. So Nifty 50 is bleeding less than the more illiquid indexes. So maybe I think the period that you have taken was the period when institutional investors probably would have been more active. So that area you could have looked into as to why the more liquid stocks suffered more during that period. But rest all is fine. So I'm okay with the paper. Otherwise, everything is fine. And this is one of the best papers as it is selected by the institution. So nothing against the paper. But these are the few things which I thought if could be added, it would come out to be a great paper. So my best wishes for the paper and thank you for writing a good paper.
Thank you so much, sir.
Thank you. Thank you, Mr. Shandilya. Thank you. Any questions to Praveena's paper?
Just check in the chat box. So
Praveena, I had one comment to your paper, which is actually nitpicking. In one of the places you've written December 2020 in the first column, where it should be December 19 in your calm period. Okay, you might want to correct that. Okay, and one other question I had for you was, have you considered other proxies of liquidity like impact costs?
No, sir, only these three.
Okay, because what happens is for liquidity of stocks, impact cost is considered an excellent proxy, and it allows you to have liquidity based on size. So when you have impact cost can widely differ when you have larger and larger order sizes, and it would therefore also make sense to, because you have done most of the work, if you just change the proxy of liquidity, you might get something interesting as well. And I'm also keen to know how you will explain Mr. Shandilya's question on Nifty and the broader market indices. What would you say to that?
So what he showed is today's returns, right, Professor?
Yeah, but remember, this is like one of the rarest days in the market that around 4% market has fallen. And Ukraine crisis is not something that you every day see in the marketplace. This is like one of the rarest occasions.
So to be frank, we were also shocked with the results, surprised with the results which we got. So we are also trying to understand why that change of direction has been happening. But however, different methodologies we tried, we are getting the same results.
Yeah, but does that explain the answer?
No. So I'm saying I also don't know what is the answer. I'm trying to figure out.
Yeah, because what you're saying can have deep policy implications. It basically says, liquid stocks will actually hit you much more than illiquid stocks.
Yes. And that result has stayed even after so many robustness checks.
So perhaps the one more question is, what exactly accounts for the feature? Have you looked at any omitted variable bias in your modeling? Have you left any important variable which could be explaining the things? Because I'm worried about one other factor, Praveena, just on the econometric side, your R squares were too low.
Yes.
So the explanatory power of the model is quite low. I'm a little worried about that part. Some places it was 20%, one place it was 5%. So,
yes.
If you remember your slides, one of the models. So are you leaving out an important variable? Because your F for the model was significant, but R squares were somewhat lower.
So
is
then
that,
I'll
think about it, please.
Yes.
All right. I have no further comment. Any comments?
Yeah. So a kind of addition to what you already said and what she is. Yes, I will agree with Shandilya sir, that excellent effort you have made. You may like to consider, see, liquidity, we always say there are some intervention, either by the regulator or at the government level. So how you would like to incorporate those things, liquidity because of X things, Y thing has happened. And because of intervention, whether Y thing has been restored or Y thing has gone other way around. So that will give you more perspective and maybe you are in a better position to explain what you want to already say.
Okay, sir.
Intervening measures, they are very important, and that is what they are policy makers. That is what they usually. There are two things. One is immediate response, and one is constructive or short to medium kind of response. So all those intervention on liquidity, how it has panned out. Maybe you would like to consider that things.
Okay, sir. Definitely.
Good efforts. Keep doing this kind of things. That will help.
Okay.
Thank you.
Thank you, Praveena. Any other questions? I guess we can go on to the third paper. Thank you, Praveena, once again.
Thank you, sir.
So our third paper today is single stock options, market dynamics around earnings announcements, evidence from India. It's by Sumit Saurav and Sobhesh, Kumar, Agarwalla and J.R. Varma. Do we have it on webinar? Webinar. Hey, hi, Sumit.
Yeah, hi, sir. I hope I am
How are you?
audible. Yeah, I'm
Yeah,
fine.
yeah.
I'm fine. Yeah.
All right. Please start with your paper.
Yes, I'll share my screen. I think my screen is visible, right?
Yes, yes. Yes. Yeah, Sumit, please start.
Yeah. Before I start, I would like to thank organizers to giving me this opportunity to present our work here. This is for the second time I am presenting my paper in one of the NISM conferences. So this paper is titled Single Stock Options Market Dynamics Around Earnings Announcement, Evidence from India. Obviously, it's a work that I have done with two of my professors here at IMA. And yeah, this is a flow of my presentation. So I'll start with a little motivation, why we do what we do. So there is a large literature that documents the information role of earnings announcement, starting from Ball and Brown 1968. So this literature has documented that the IV of the single stock options, particularly ATM IV, increases before earnings announcement, peaks at the day of earnings announcement, and decreases afterwards. However, there are very few papers that try to or that uses the full richness of the implied volatility curve, or what we call in our paper the asymmetric risk. So what we mean by asymmetric risk is that the investors can take directional bets in the options market, like going long on OTM calls and shorting OTM puts and vice versa. So none of the papers have, and this trade will be captured by the skewness of the IV curve rather than the ATM the implied volatility of at the money options. So not very few papers have captured this dynamics around earnings announcement. So we in this paper try to capture that. Additionally, the most of this literature is focused on US market, and little work is done on emerging market like India. And there are two other reasons why we select India for this work. One is that our single stock options market is one of the largest by volume in the world. And second, we have parallel liquid single stock futures market that attracts a lot of informed traders. And this raises a very important question that during earnings announcement, which market would be preferred by investors? Is it spot market or futures market or single stock options market? So before I will go into detail, I will just mention our research questions and key findings in case I don't get time. So we in this paper aim to address three broad questions. One, how the behavior of single stock options implied volatility and volume changes or reacts to earnings announcement. Second, we try to examine the preferred market of investors. Is it spot or futures or options? And third, can the options market predict earnings surprise? Because that would be the sign of informed traders active in the Indian options market. And for that, we use the earnings announcements between 2015 to 2019 for all the firms which have derivative traded. Our key results are as follows. One, we find that there is significant increase in volatility levels during earnings months vis-a-vis non-earnings months. Second, we find that there is a differential impact of earnings surprise on the shape of IV smile and P by C ratio, put to call ratio. Third, we find that our O by F ratio and O by S ratio, which is options to futures ratio and options to stock ratio, it shows a monotonic increasing trend leading to earnings day and then fall afterwards, showing that the options market is preferred over spot and futures market during earnings announcement. Then we also find that the ATM IV, the IV of at the money option, doesn't predict earnings surprise, whereas IV skewness of the implied volatility curve, which we also call RRIV, and P by C ratio predict the direction of impending earnings surprise, sort of showing that informed traders are active in the market just before earnings announcement. So overall, in this paper, we find that the option market is forward-looking and used by informed traders. Now, coming on to the literature review and our research questions, here I will elaborate in little bit more detail. So volatility as measured by implied volatility, IV, increases before earnings announcement and decreases afterwards. It's widely documented in the literature, and our paper is not the first one to document it. Then there are papers that try to examine how the positive and negative news affect the buildup and change of implied volatility during and after earnings announcement. In the recent paper by Beaver et al., they find that the information content of the earnings announcement has increased over the period of time. But most paper in this domain has used implied volatility of at the money option, thus misses out the full richness of the IV curve. So we in this paper aim to fill this gap by one, examining the behavior of different IV curve parameters in EM month versus non-earnings announcement month. And second, how the behavior of ATM IV skew changes or gets affected by positive and negative earning surprises. Coming on to our second research question. So option volume and O by S ratio has been used to examine the market reaction to earnings announcement by Turong et al. and Rai and Rai et al. 2015. Then previous literature has documented that the high option volume or O by S or high O by S ratio result into a tepid reaction from spot market to earnings announcement. But due to the lack of liquid single stock futures market, little is known about the behavior of O by S ratio, the options volume to futures volume ratio around the world. So similarly, there is very little or very scant literature on how the P by C ratio, put to call ratio, reacts to different earning surprises. So in our second research question, we fill this gap by examining the behavior of all the three ratios around earnings announcement, and we also examine how P by C ratio, the behavior of P by C ratio gets affected by the earnings surprise. Now coming on to our third question. So so options market is known to be the preferred market for informed traders, and the reasons are simple. One, the short selling is easy. There is leverage effect. Then one can use private information by taking different position. By different position, I mean by using different strategies like put spread or butterflies. So due to all these factors, options market is known to attract a lot of informed investors. And empirical asset pricing literature, on the other hand, also documented that the options market can predict, particularly implied volatility and volume in the options market can predict the future stock return. High predictive power options market before, and there are papers who have also documented that the option market can predict the outcome of earnings announcement and M&A, mergers and acquisition. So we, in our third research question, we examine how the ATM IV, our IV skew and P by C ratio behaves leading to the earnings announcement day. So this investigation would inform us about the extent of informed trading in the Indian single stock options market. So data for the study is taken from standard sources, and I have already mentioned the time period considered in our study. We have applied standard liquidity filters to remove illiquid options from our data set. And one thing that I would like to highlight, to adjust for aftermarket our earnings announcement, we followed Berkman and Turong 2009 and adjusted the earnings announcement day by adding one day into the earnings announcement day.
Can you repeat that, please? Sumit, sorry to interrupt. Could you repeat that, please?
So what we did is, because whenever the earnings announcement has happened after market hour, we considered next day as the day of earnings announcement, not the day. So this is a standard practice. So Berkman and Turong 2009 has done the same thing. So our final sample consists of more than 2,000 firm quarter observation with 191 unique firms. So I will not go into much detail how we fitted IV Smile, because it's a standard technique and many papers have used the same technique. So basically we fitted quadratic smile and in IV and delta space and extracted ABC, and based on these three parameters ABC, we estimate three IV curve parameters. One is ATM IV, which is at the money, the implied volatility of at the money options. Then IV of delta 0.75 means implied volatility of out of the money put options. Then IV of delta 0.25 options, which means IV of out of the money call options. Then we estimate IV skew, which I have called risk reversal here as well, which is the difference of the IV of out of the money call and out of the money put. So to give a small intuition here, so this RRIV would be positive if out of the money calls are more expensive than out of the money puts, and it would be negative if the reverse is true. So if the the way this variable is used in the literature is when the market is bullish, this parameter becomes positive, and when the market is bearish or when the market expects negative news, this parameter becomes negative. So the way we have measured earnings announcement surprise, we used two well-known or well-established measure. One is the standardized unexpected earnings, and another one is the surprise reported by IBES, again widely used measure in the literature. So coming on to our result part, so this is a summary statistics of our data. This is the correlation table. I would like to highlight few things. Number one, that you can see that both our earnings surprise measure is positively related with RRIV, which is IV skew, and the correlation increases as we move close to earnings announcement day. So RRIV T-1 is the value of IV skew 1 day before earnings announcement. Similarly, RRIV T-2 is 2 days before earnings announcement, and RRIV T-3 is 3 earnings announcement. So as you move close, the RRIV and surprise, the correlation increases and the correlation is positive, showing that the informed traders become active as we move close to earnings announcement. Second, we find similar relation, but in the opposite direction. The relation between earnings announcement and P/C ratio is negative, and the correlation increases in the negative direction as we move close to the earnings announcement. So in this slide, I show the result of our first research question. So in table, we have reported the average value of our 3 IV curve parameters: ATM IV of delta 0.75 options, and IV of delta 0.25 options. And as can be seen here, that in earnings announcement month, all the 3 parameters are higher than in pre and post earnings announcement month, and the difference is statistically significant, showing that in the earnings announcement month, the whole smile moves up, thus providing us the evidence that the uncertainty remains elevated in earnings announcement month vis-a-vis non-earnings announcement month. And when we did event study kind of analysis, where we plotted the average value of all these 3 parameters in a plus minus 10-day event window, we find that all the 3 parameters show a monotonically increasing trend until earnings announcement day, and then comes down afterwards, showing that earnings announcement reduces a lot of uncertainty in the market. Now, in this slide, I have shown how the ATM IV of at the money options get impacted by the surprise. So as expected, we find that the surprise doesn't differentially impact the ATM IV. So the ATM IV shows a general trend. It shows a monotonic increase before earnings announcement and then comes afterward, but it is independent of the surprise embedded in the earnings announcement. Now, in this slide, I have shown how IV skew behaves with respect to earnings announcement surprise. And as can be seen in the graph, we find that in the case of, let me explain a little bit. So what we have plotted here is the average value of RRIV in a plus minus 10-day event window. And then we have categorized earnings announcement into surprises: large positive, large negative, and slightly positive and slightly negative, based on the quantiles in which the earnings announcement surprise lies. And we find that the IV skew become highly negative in the case of earnings announcement having very large negative surprise. So which shows that the RRIV reacts to or the behavior of RRIV is not independent of the earnings surprises. And one more thing which one can see here is that the trend start, the downward trend start much before the day of earnings announcement, which sort of shows that the market anticipates that the negative news is going to come. Options market is able to anticipate that the negative news is about to come. Now, coming on to the question that which market is preferred by the investor, is it spot market, futures market, or options market? For that, we have plotted the mean value of O by S ratio and O by F ratio in a plus minus 10-day event window around earnings announcement, and you can see that both the ratios, so O by F and O by S ratio, show a monotonic increase and decrease. So it clearly shows that the investors prefer options market over futures and spot market during earnings announcement days. Now, coming into how put P/C ratio is affected by earnings announcement. So as can be seen here, that the earnings announcement increases more in the case of the P by C ratio increases more in the case of highly negative news than in the other two categories. And the method, the way we have plotted this graph is same as the way we have plotted IV skew and ATM IV curve. So again, it sort of shows, and the trend starts much earlier than the earnings announcement day. This sort of shows that the market is able to expect negative news. That's why the put volume increases with respect to the call volume in the market. Now coming on to the part whether these parameters RRIV or P by C ratio or ATM IV is able to predict the surprise embedded in it, we estimated this regression equation 5, where we regressed our surprise variables on these three variables with a bunch of other controls that already, and for these controls we have, these controls are derived from the literature what previous paper have already used. So RRIV T minus N is basically 1 day, 2 day, and 3 day before RRIV, and similarly P by C ratio and ATM IV is again 1 day, 2 and 3 days before earnings announcement days before parameters. And so this is the result of the regression equation 5, and we find that the RRIV and P by C ratio is able to predict the surprise. The 1 day before RRIV and P by C ratio is able to predict the surprise of the earnings announcement, whereas ATM IV does not, and it is not surprising. It basically confirms what we see in the graph. So then we reran the same regression equation for day number 2 and day number 3, and we find that the day 2 and day 3 parameters are unable to predict the impending earnings surprise. This sort of shows that the informed trading becomes increases just 1 day before earnings announcement, and just 2 days or 3 days or even few days before earnings announcement, the market doesn't have ability to decipher or to predict what is going to happen in the earnings announcement. Now coming on to the robustness part, so in the interest of time, I'll briefly explain it. So instead of using a quadratic function to estimate IV smile, we use an alternative technique and estimated the same parameters and we do the same analysis, and we find that all our results remain robust even if we use alternative measures of IV smile parameters. So to conclude, so in this paper we examine how IV and volume dynamics or behave during IV and volume of SSOs behave during earnings announcement, and we find that the uncertainty and asymmetric uncertainty are both elevated before earnings announcement and come down after it. Second, we find that earnings surprise have differential impact on IV skew and P by C, but not on ATM IV. And third, we find that the market is not able to distinguish between forthcoming positive and negative earnings surprises, except perhaps very near to the earnings announcement days, which sort of shows that the firm internal control or enforcement of insider trading laws ensures that the actual content of the earnings announcement remain confidential until it's very close to the day of release. Thank you.
Thank you, Sumit. Excellent presentation. Mr. Shandilya, for your comments, please.
Select first one, screen, yes.
Okay, yeah. So, Sumit, this is one of the finest paper I have read among so many papers given to us. And according to me, it ticks all the boxes of a good report, good paper on how it is presented. The best part is when you talk about options and futures market, and especially in India, I think a lot of things can be said because we are number one in terms of options and futures market, in derivatives market, in so many ways. And NSE has the 99.9% of the share, which is what you have also pointed out. So that way, the whole report has come out very well. It describes everything in great detail. The best part is it focuses on emerging markets and India, and especially futures market. It compares, your report compares futures and options market. And what it says is investors are getting into more into options to express their opinion or about surprises, which is quite different from what used to happen in early 2000, when around 9th June 2000, when we started options and futures. Things were different because then I think futures market was rolling the roost, but things are turning according to you, and that's a fact also. What you are showing is there is significant increase in volatility during earning announcement month, and that is gradually increasing during different strikes. So what it's showing to me, according to your paper, is like we are becoming more efficient, and that efficiency is getting reflected through the option market. And the change in a smile after earning announcement, which is what you said. So I have one suggestion to make here, and that suggestion is when you talk about a smile should be colorful, and some of the graphics I think could make some more improvement, because for some elderly people like me, I needed a little more focus to look at.
I would agree. They could have been bigger.
Yeah,
I could not read X and Y axis.
Yeah, so always when you talk about a smile, let me smile first before you give any report. So I think now all these software and analytics are coming. Just you need to change 1 to 3, and it comes up with different colors. So I think it could have been done that way to make it a little more attractive. And you have stated that options have emerged as preferred tool for expressing emotions, opinion in market, and that's very good, because what it shows, contrary to what was happening earlier speculators were rolling the roost in market, and that's why single stock futures were predominantly used for everything in market. Now options are being used, so it means institutions and host of other participants are getting into market for expressing their opinion, which is a great part of this report. And what you say is at the money implied volatility doesn't predict the earnings surprises. The skew of option, RRIV, and volume of PCR do. So this is a very different finding, and that's interesting, because what it means is like you need to be, the investors can look at various other things, not just the at the money option, which is mostly more liquid in the market. The interesting part of your talking about PCR is when you talk about put call ratio, I understand that investors during time of panic, they look for insurance, and obviously the PCR should increase. But one question that was lurking in my mind is like, what if I'm an institutional investor, and instead of buying put option, I sell call option because I have lots of holdings of the stock, and that is safer for me also because I'm covered by the holdings. So would you have like to look into those aspects, that what if institutions do more of covered call writing instead of buying put option? So what would happen to these surprises? And it's obvious that predictive power increases closer to a day, and what you are saying by saying this is information is gradually being passed on to market participants, and market participants are taking time to appreciate the information content in the market, and that way regulators have done a pretty good job of ensuring that there is no leakage of information 3 days prior to 1 day prior, because that's what your report is coming out. So I think it's a good message to the regulators that all the Chinese walls, all the code of conduct enshrined for the corporates, and they are working. So that way it further affirms the regulations that have been made over the years. And one best part of your report, which is what I liked, is you have used delta 0.75 and delta 0.25, which is where this is very interesting, that you go to out of money to in the money, and then you take the reversal of that, which is what I don't get to see in many of the papers. So that's a very good part of the report. And yes, like you have cited some of the paper, very old paper of 2010 around something, and as early as 2020. So the good mix of literature cited in your review, which is something I like. Yeah. So one question that is again like that bothered me is your definition of illiquidity, or something that you have avoided is 5 minutes of trading window for illiquid stock options. The question that is in my mind, why 5 minutes? I think options, as per the definition of SEBI, or like as we have defined, all the best stocks in the country are included in option. And if they are trading only for 5 minutes, why not 10 minutes or 30 minutes? Because I think 5 minutes is too small a window. The liquidity could have been further, you could have gone a little more. I don't know why the 5 minutes were selected. And if at all some stocks are getting traded for 5 minutes window, I wonder that why they are still there in that FNO space. And the two surprises measures that you're using, IBES and SUE, both are coming up with the same findings. So that's perfect. Yeah, so this I have said that whether covered call would have made any change differences. One interesting thing that you have mentioned in your report is like the 191 forms that have been used in a study, and analysts have used this. So whether there is any dispersion in terms of the different stocks. For example, in US, what happens? They mostly cover the large cap stocks. But over here, from your paper, I cannot make out whether the whole emphasis is more on the mid cap or small caps, because analysts will be more interested in making money, and maybe they would be following those stocks where there are more returns or more attractions. So I don't know whether like for the Nifty 50 or like Junior Nifty or the S&P, the Nifty 500 stocks were more followed by these analysts. And yeah, so you have used the near month contract. I would be more interested that if what would have happened if you had used the mid month contract. Of course, I understand that there is no comparison between the near month and mid month, but of course, the mid month is still much more liquid than the far month. And I think we have the three spectrum of all these contracts traded in the market. So probably the like you could have also, as you talk about robustness, the robustness could have been further confirmed if you had used the middle month contract. And I think some way some participants would be smart to express their opinion around those earning surprises. And yes, what you say is correct. Is market is unable to guess the direction of surprises except until very close to announcement. And this I have stated. Yeah, and one more thing, which is what, because like you have written so many things, so it gives me more opportunity to look at so many aspects of your. So you have used regression model where you have used buy and hold return for T-10 to T-2 or T-1. My question is, could you have looked for 30 days? Because when you were talking about buy and hold return, little longer duration would have added more value to the robustness of this. I don't know whether authors have looked at this, but my sense is you have used both momentum and buy and hold, because you have already used momentum. So probably buy and hold for the little longer duration would have made slight differences that I don't know, but probably, yes. So that's all. But anyway, this is probably the best in this this heading of this presentation, and you presented it very well. And the fact that you talked about futures, options, and stocks, and the volatility smiles all have come up wonderfully. And it's a great paper, and I wish you all the best. And this should get published somewhere, because the content and quality is so good that definitely it deserves to be published somewhere. So all the best, and thank you very much.
Thank you, Mr. Shandilya. Sumit, would you want to respond?
Yes, sir. So thank you, sir, for the wonderful discussion. And so I have written some points. I don't know whether I'll cover all of them. I would be able to cover all of them or not. So first, about the better graphs. So I got the same feedback from my advisor as well. So in the revised draft that we have submitted to a journal, the graphs look much better. And as pointed by you, I have made the levels little bit bigger. So it's a valid criticism. I take it. I mean, it's my fault. Second point you were talking about, why not the investors can write covered call. right? When I am using P by C ratio analyze how the P by C ratio is getting affected by earning surprise. So basically, you are talking about supply side effect. So one thing that comes to my mind is if that is true, then that would reflect in order imbalance. Like when there is a negative surprise, then there is from the supply side there would be a urge to sell more calls. So that would be captured by that. I don't think that. And the other point that comes to my mind is why investors will not sell calls, because writing call requires margin as well. So I have read a couple of papers that writing call and buying puts are same, but investors prefer buying put over writing calls because writing calls will require margin. And obviously, if you buy put, you have to pay a premium upfront. Your third point about why to take 5-minute time window or for liquidity, why not 20 minutes, 30 minutes? So I mean, frankly speaking, I have followed some of the previous papers that my supervisors have written and they got published in a good journal. So, but you are right. I mean, we can take 10 minutes, 20 minutes, 30 minutes. For robustness, one can check that. I take your point. It's a valid criticism. The next point that you made is why not use next month? So sir, the liquidity drops drastically the moment you go to next month. So the liquidity is highest in the near month, and somehow the literature uses near month contracts. I mean, if you'll see all the papers that I have cited, in almost all the papers, they use near months. That's why we have followed this. But you are right, one can also look next month contracts. And the last question about the last point that you have highlighted, that I have controlled for momentum and buy and hold in the same in the same regression. So I should have taken a longer time window for buy and hold. I'll definitely check it. All the points you have made is, I agree, it's valid, and it will add value to my paper. So let's see in the next version when we revise it, we'll try to incorporate these points. Thank you, sir.
Thank you, Sumit. Any other questions? Vidhu?
Yes, sir. Yeah, very quickly, how does liquidity change close to the earnings announcement, before and after?
So it increases and then comes down. So you're talking about volume, right?
Yeah, volume, open interest, whatever. So does that tell you anything more than what you have explored?
So here, what we have done when we studied volume, we studied ratios. So there are papers that study only volume, and the normal finding is that before earnings announcement in all the markets, volume increases and then comes down. So there is abnormal volume and volatility. We wrote another paper, but in that paper, we analyzed spot market behavior in our earnings announcement. So I don't know about.
This would be across spot, future, and options, right? So if you're talking about options in contrast to futures and spot,
that's why we have taken ratios. So once you take O by F, if both the variables, so if volume in options market goes up as well as in futures market, if the rate of increase in options market is higher, then O by F will increase, and if the rate is slow, then O by F will decrease. That's the sort of argument.
Yeah, please, Musunuru.
In the presented paper, likewise earlier paper also, what we have seen the
Slightly louder.
Yeah, in the presented paper, what I observed that likewise other papers, what we have seen current in this session, R square was quite low, like 0.12. Is that because of the omitted variable bias, what we have said?
Not always. Sometimes in time series regression, the explanatory power of those models is very, very low. If most of the data here is high, daily data.
High frequency.
No, daily. High frequency is which is lower than daily. I mean, the time period is lower than daily. You will see R square even lower. Okay. So it's not always the case. But in the previous paper, that was using daily data. And I have one more comment on the previous paper, by the way, which I could not. I don't know if Praveena is still there. The correlation matrix that she showed, she said everything is less than 0.4. You don't present that. I mean, where was the statistical significance? In all papers we have seen, your paper and obviously this paper, typically whenever you make a statistical statement, you have to give the p-values, right? But that was missing in the correlation matrix. So, but Sumit, may I ask a few questions as chair? Yeah, please go ahead.
Yeah. I mean, coming on to the low R square part. So
Yeah.
what I have seen with a little bit of experience, so last 1 year I have been doing research. What I have realized is when you will regress ATM IV, you will find higher R squared. But whenever you are dealing in IV skew, so I have seen the literature, all the papers will have low R square. So technically speaking, we don't have better explanation of IV skew. That shows that all the variables doesn't matter, form level fixed effects or time fixed effects, other analyst dispersion, coverage, all the things put together doesn't explain more than 15-20% of the variation in the IV skew.
I would agree.
So
Sir, if all the papers are getting low R square, why is it so?
No, that's because of how much you can explain. I mean, it's hard to.
At max, we can that.
They say, right? I mean, you should never predict, and last thing you should predict is the future. So you don't know what's going to happen. But I have some comments, Sumit, on your paper.
yes, sir.
So first of all, there is a sharp rise in the OF versus OS. Okay. The good thing that you've done is in the paper you stopped at 2019, so you're not dealing with anything with the pandemic. That was a smart thing to do. But that was, otherwise your results might have been skewed in whichever way, right? That was smart.
Yeah.
But one other thing is, since peak margins were introduced in various stages, I think beginning last quarter of 2019, it's become steadily more expensive for people to trade in the spot markets. So you've seen volumes sort of peak out in the spot markets and volumes starting to increase in the options markets. I think you should keep that in sort of mind. I mean, part of the peak margin increase happened during the pandemic. You are safe from there, but peak margin was announced in 2019. So look at what part of your time period could have been possibly affected by the starting of the peak margin announcements. It started with 25, then 50, then 75, then 100. So that became, leverage trading became more expensive. So you made that point, by the way, that options allow leverage trades, and leverage trades in terms of margins were allowed in spot markets, but with peak margin, it's becoming very difficult. One small point there, you said options allow private information. How? I mean, the strategies are there. You can have all kinds of strategies. You can't have short sales in, our SLBM is not so great. So, options are great in terms of all kinds of strategies and complicated set. And you can go on the long and short side, but private information was a question. The other thing is, I wanted to ask you, why use Black's model for the IV? Why did you not use a simple, fit the IV using the traded strikes? So you will get a smile anyway. Just take all the traded options. You will get an IV smile, a broad IV smile, and then you can fit a quadratic model into it. You don't want to go cubic or quartic because you'll have kinks. The quadratic, you're getting a parabola, so it's fine. But why use Black's model? Just a question there. On the 5-minute part, I just have one observation. So at NSE, we have around 90,000 options trading per day, available for trading per day. But the number of options that trade every day is 16-17%, not more than that. So Sumit's point about why you don't use near month, the drop in liquidity is very sharp. So you will see that at the near expiries, weekly expiries for the Nifty or Bank Nifty, or for the stocks near month expiry, the liquidity is huge. But after that, there is hardly any liquidity. So I think that could be one reason, and that also sort of determines your hold period. You don't have liquidity. What can you make a statement about 40 days holding period? You have to stop at 30-day period. And other than that, on coverage, you had a question on coverage, right? See, the number of stocks where derivatives are allowed is 191. The number of stocks where analysts cover is about 500. So analysts cover a wider universe than the derivative universe. So luckily that bias will not be there in his paper. So everywhere derivative universe is there, those stocks are all decently covered, generally decently covered. You will not have that paper. And on one point that he raised, Mr. Shandilya is from SEBI. I think you should send him your previous paper about how the UPSI announcement of SEBI, that regulation has actually dropped, UPSI news sort of coming out, which is sort of coming out in your paper. I think it'll be nice to share that paper. And lastly, just one other question. I mean, you make an announcement of post-market hours and you add one to it, right? Anything that comes after, after market, you add one to it. And then you also show that option market is able to get the news before, at about 1 day. I'm kind of worried about that part. I mean, are we basically saying that this 1 day is coming before, because you're adding that 1 day? Are we, because, so I'm trying to think that the market gets it on the day of the earnings announcement, on that day. But because you're recording it as 1 day next, I'm not sure. It is, I mean, my thing is, because I'm not sure how many of the earnings announcements are made during market hours. I think it should be a good idea to have all earnings announcements during market hours, but some guys do it after market hours. Many of them, some of our largest companies do it.
They do it
And
after market hours.
because of your adjustment, you're adding a day.
Yes.
This is something to sort of think about. And last comment is, you said NSE, I mean, we are the largest derivative markets FIA 2020. It's also FIA 2021.
Yes.
So yeah, that's it.
Yeah.
But my compliments on an excellent paper. Yeah.
Yeah. Thank
Any
you.
other questions?
Okay, so I wanted to ask, right? So like I had two questions. So as an option trader, so what do you think is the best strategy during the earnings? Like triangle, do we go for triangle or I am butterfly? Like I want to what do you think? Like with the increasing implied volume.
I think it's very unfair to ask him this question because you should be asking it to someone from market because he is
with the like he's observing the prices, right? So.
Yeah, but Sumit, if you allow me, I can tell him something.
Yeah. Yes, sir.
Yeah,
So I'm not an active option trader.
Yeah.
So I have no idea. Sorry.
So, like if you are actually trading options in market, he has mentioned about his paper PCR, put call ratio. Put call ratio have a tendency to shoot up and go down, and they, my experience is, they do a pretty good job of giving you direction whether market is going, because large number of put writers are institutions who are holding information. And with this market, you can only make money if you have information, whether by virtue of your analysis or something. So you should be looking at PCR very closely, and the changes are very important. So I look at PCR, and 95% of the time I have found that this has given satisfactory result. But of course, if you look at other traders, they might be using combination of things, but PCR is a very good indicator.
Okay, so one more question. Okay, so like, there is an obvious increase in like volatility, as you said. But like I tried to trade some earnings, and like there is some like deviation when the earnings are in the first week of the month and in the fourth week of the month. So like, how do you consider that, or have you thought about it?
So I think basically what you are talking about. So there is this effect. It is, I mean, several papers have documented it, that whenever a particular firm in a particular industry, so the first firm who announces earnings numbers in a particular industry, the reaction is sharp. So suppose in IT industry, TCS goes and announces its return or announces its earnings number first, then there will be a sharp reaction because investors get the direction. So after that, if Wipro comes and again announce the earnings numbers, maybe in the last week of the same month, the reaction would not be that sharp. But what you are saying is right, and many papers have, not in the Indian context, but in the US context, there are many papers that have documented this kind of behavior.
Actually, I'm talking about a single stock, like the theta value I'm talking about it, like irrespective of the spillovers. So irrespective of other results, like if I take only one stock and it's the increase and decrease in implied volatility, if like in Q1, it declares its results in the first week of the month, and like in Q3, Q4, it declares the result in the fourth week of the month. So do we have like?
So are you controlling for? So when you're talking about these things, do you know that it is possible that in Q1 the earnings numbers would be far more optimistic than in the Q4?
Yeah.
So you have to control for all these things and then see if it makes sense or not. I don't know.
And one more reason, I mean, you're talking about theta, right? I mean, the time to expiry also matters. So you probably answered half of your question when you said it's beginning of the month or end of the month.
Yes. So for conclusive evidence, or is it there is more change in implied volatility at the start of the month or at the end of the month?
I think you should check.
Yeah, actually.
So any other questions or observations?
Just see in the chat box.
No, sir.
So that brings us to the end of this session. We had three very interesting papers. All three of the papers made us sit up and take notice. First paper was by Masudul Adil, which was about a very interesting index, the Baker Policy Uncertainty Index. I would urge all of you to have a look at that index. It looks at, it started in the 80s, started looking at newspaper articles and how, when you see newspaper articles and news coming out of it, what do they do to the markets? So is it markets that affect news or news that affect markets? So these guys started doing it in late 80s. Now they have done it across countries, and it gets better and better. And it was obvious that they should come up with something like the Twitter Policy Uncertainty Index. Very interesting stuff. Thank you, Masudul. That was cool stuff. The only suggestion is please try and do it, a pre-pandemic period, and you will get probably very good results. The other paper was by Praveena Musunuru. That was also interesting. We basically looked at several proxies of liquidity and how they affect stock returns. Some of the results were very interestingly counterintuitive with Mr. Shandilya. And by the way, I should thank you. Excellent presentations. I think your discussion of Sumit's paper. Sumit, what do you think? I mean, it was very good. You really brought out several salient aspects of the paper. So my compliments to you on that. So Praveena's paper, again, made us sit up and take notice. Very interesting paper, very nicely written. I completely agree. Her results were, presentation was very, very well done. One nitpick I had was, December 19, December 20, that is fine. But correlation matrix should have significant, years. And Sumit's paper, of course, very, very interesting questions. I mean, it essentially looked at single stock option dynamics. By the way, we are also doing something interesting internally on IVs. And that made me think a lot more about what you're sort of trying to do. Very interesting paper. And this RRIV, as you call it, the option skew, is something that, that is definitely interesting to look at. And I would repeat, share your previous paper with SEBI. I've told Sobhesh earlier, I think we should do it. It's very nice. This is an example of how a regulator has done such a good job in terms of controlling leak of unpublished sensitive information. So with that, we come to the end of this session. I thank everybody. I thank the audience. Thank you. Thank the papers, and thank you, discussants. Thanks a lot. Bye.
Thank you, everyone.
Thank you, sir. A big thanks to all presenters as well. It is almost ironic that when I was trying to define the theme for today, that is capital markets in changing context, the very first quote that hit me was Vladimir Lenin's. He says, when I was trying to define, he says that there are decades where nothing happens, and then there are weeks where decades happen. So today's Russia-Ukraine conflict is a very good example of that. And it was an incredibly insightful session and a great learning experience for all of us sitting here. I think there were some great comments that were made by both Mr. Shandilya and Dr. Patnaik. Thank you so much for being here, for making the time. Thank you to all paper presenters, all attendees, and everyone who joined in online as well.